Have you ever wondered how investors spread their money across hundreds of assets without spending hours researching each one? What if there was a simple solution that allows you to diversify easily and minimize risk while still growing your wealth? Today, we are going to explain ETFs in the easiest way possible, showing how they can simplify your investment journey. Don't forget to like and subscribe so you never miss practical strategies that can transform your financial future immediately. 1. What ETFs are. Exchange-traded funds, or ETFs, are investment vehicles that bundle together multiple assets like stocks, bonds, or commodities into a single fund. Instead of buying each asset individually, investors can purchase shares of an ETF and gain exposure to the entire portfolio. ETFs trade like regular stocks on exchanges, which means you can buy or sell them anytime during market hours. This combination of diversification, flexibility, and accessibility makes ETFs a powerful tool for both beginners and experienced investors. Understanding the basics of ETFs is the first step toward building a simple yet effective investment system. 2. How ETFs work. ETFs pool money from many investors to purchase a variety of underlying assets, which may include hundreds of stocks or bonds depending on the fund's focus. Each share represents a proportional ownership of the fund's total holdings. Unlike mutual funds, ETFs trade throughout the day at market prices, which allows investors to react to market movements instantly. They can track specific sectors, indices, or commodities, providing targeted exposure without the complexity of managing multiple individual investments. 3. Benefits of diversification. One of the main reasons investors choose ETFs is for diversification. By holding multiple assets in a single fund, you reduce the risk associated with individual investments underperforming. Diversification spreads exposure across industries, sectors, or countries, helping protect your portfolio during volatile periods. ETFs allow you to achieve this broad exposure efficiently without requiring substantial capital. Over time, consistent use of diversified ETFs can enhance stability and long-term growth. 4. Lower costs. ETFs are generally more cost-effective than mutual funds because they are passively managed in many cases, meaning they track an index rather than relying on active management. Lower management fees translate directly into higher net returns over time. Additionally, since ETFs trade like stocks, there are no hidden fees for fund operations, and investors can avoid penalties for frequent trading in most cases. Cost efficiency is especially important for long-term investors who rely on compounding to grow wealth. 5. Liquidity and flexibility. ETFs offer high liquidity because they trade on stock exchanges, allowing investors to buy or sell shares quickly. This provides flexibility to enter or exit positions whenever the market is open, unlike some investment vehicles with strict redemption schedules. Liquidity ensures you can react to changes in the market or your personal financial needs without delay. It also provides an opportunity to implement strategies such as dollar-cost averaging or rebalancing efficiently. 6. Transparency. ETFs are highly transparent because their holdings are disclosed regularly, often daily. This allows investors to see exactly what assets they own, unlike some funds that only report periodically. Transparency enables better risk assessment and helps investors align choices with personal goals. Knowing the composition of a fund builds confidence and allows for more precise portfolio management. It also helps in evaluating sector exposure, geographic diversification, or industry concentration. 7. Tax efficiency. ETFs are known for their tax efficiency compared to other investment vehicles. They use mechanisms that minimize capital gains distributions to shareholders, which can reduce your tax liability. This efficiency is achieved through in-kind creations and redemptions, limiting taxable events. Over time, keeping taxes low enhances the power of compounding because more money remains invested. Tax efficiency is especially valuable for long-term investors seeking steady growth without losing significant portions of gains to taxes. 8. Access to different markets. ETFs provide exposure to markets and assets that may be difficult to access individually, such as foreign stocks, emerging markets, or commodities like gold and oil. This accessibility allows investors to diversify beyond domestic markets, spreading risk globally. They can also focus on specific sectors like technology, healthcare, or clean energy, without needing extensive knowledge or capital. ETFs create opportunities to participate in trends and sectors that might otherwise be complex or costly to enter. 9. Choosing the right ETFs. Selecting the right ETF requires considering factors like the underlying index, expense ratio, liquidity, and alignment with personal investment goals. It is important to analyze the fund's objectives, track record, and how it fits into your overall portfolio. Some ETFs focus on growth, while others prioritize income or stability. Understanding these nuances allows investors to construct a balanced and effective portfolio. Making informed choices reduces unnecessary risk and improves long-term results. 10. Building a portfolio with ETFs. Once you understand ETFs, you can use them to construct a diversified, low-maintenance portfolio tailored to your financial objectives. Combining funds that target different sectors, asset classes, and geographies creates balance and reduces volatility. Periodic rebalancing ensures your portfolio remains aligned with goals and adapts to market shifts. ETFs allow consistent investment habits through regular contributions, dollar-cost averaging, and long-term strategies. Now that you understand how ETFs work and why they are the easiest way to diversify, you have the tools to create a simple, efficient, and low-risk investment system. Apply these strategies consistently, stay disciplined, and watch your portfolio grow steadily over time. Don't forget to like and subscribe so you can keep learning practical methods to enhance your wealth and make investing accessible and effective for your future.